All right. All right. Hi, everybody. Thanks for showing up on a talk on crypto regulation on a sort of last hour of the conference. I'll try and make it as entertaining and succinct as possible, but yeah, if you have any questions at the end, let me know. So my name is Markova. I'm based in Brussels. I work for a company called FTI Consulting. I'll tell you a little bit more about that. I guess the main thing about me at this stage is that I'm not the executive director of INATBA, who is supposed to be giving this talk, but he got held up by COVID-related restrictions. Excuse me. So if Mark was here, he would have told you that INATBA stands for the International Association of Trusted Blockchain Applications, and it's a trade body and a platform based out of Brussels as well that we work closely with. And it was put together in order to give a voice and a coordinated voice of the 163 companies until that moment that care about the future of distributed ledger technology. Now, all of my talk is going to be about financial services, which is one of 15 work streams or working groups that INATBA has, but there's more to it, the organization to it. We work very closely together. Indeed, I work for a big international consultancy firm, but what that means in practice is that we follow very closely all developments, political and policy developments from Brussels to Washington that could affect the future of distributed ledger technology, and we'll talk a little bit more about the European context today. So the view from Brussels. I mean, those past couple of days here have had really high energy, been really interesting and amazing. The view from Brussels is slightly different, and I'll tell you how. First thing first, when you talk to governments about potentially changing who issues money and the rails on which money are moved, or the payment rails, they start thinking about control and they start thinking about trust. This is true for Brussels. The EU officials call that strategic autonomy, digital strategic autonomy, but it's also true for Southeast Asia, it's very true for China, South Korea, the States. I mean, you kind of see that trend over and over again. And the idea for big social platforms to create their own tokens really put a lot of governments on the same level of alert. That it's really quite a bit more about control, in my opinion, than it is about financial inclusion, for example. Now, when you're in a room like that, in a conference like that, you tend to focus on the stellar growth that distributed decentralized finance has had, the growth over the past year and a half, from 1 billion to 68 billion a couple of days ago, and that's all positive stuff. But when you grow that quickly, it makes it that much harder to stay under the radar, politically and regulatorily speaking. So these are some of the concerns that policymakers in Brussels have. And while it is, for example, the objective of our cooperation with INATBA to contribute to the narrative, to make it data-driven and supportive, we have to understand where these concerns are coming from, because that gives us the room to maneuver. We have to know what policymakers are concerned about, so then we can have an idea of what we can and cannot change. And the best way to engage is to recognize those concerns, to address them, agree or disagree with them, and explain why. For example, I mean, this shouldn't be a hard guess for anybody who's looking into this space. Stablecoins, the EU calls them e-money tokens or asset reference tokens, are the biggest areas of concern. And it really doesn't matter whether you're issuing them as a centralized entity or a decentralized entity, really, because the concern is what you do with the token when it's out there. So there was perhaps an idea at the beginning of the regulation that some of the DeFi projects could be left more out of scope, because regulation is indeed written for a centralized entity and really at all doesn't sit comfortably with the DeFi concept. But the prevailing concern is that it allows private entities to start functioning like central banks, and even where they don't, it allows private entity to continuously control payment rails. And that concern, I have to say, from an EU perspective, is as big when it comes to private sector as it is about foreign governments. And that's why you have the European Central Bank talking about issuing a digital euro as a form of protecting basically the sovereignty of the EU. which is why non-euro stablecoins, like all the private solutions we have, or the majority of them, are a particular concern. And that's where we start thinking about precedents. Do we have them? Don't we have them? We don't have a precedent of moving money to each other in the EU in currencies that are not the EU, the euro, the eurozone currencies, or sorry, the EU currencies. We don't have a precedent of holding our money in something other than euros or EU currencies, but we do have a Brussels level concern of what happens to the euro and the international role of the euro when you have big, particularly private sector players issuing stable coins that are backed by a dollar. Another uncomfortable topic is collateralization, particularly who controls it. In a DeFi project, it's the user who controls it. In a traditional finance project, it's the central entity who controls it. Reconciling those two things together is not an easy process. It doesn't sit so, there's no comfortable solution at this point of the negotiation process. How much collateral should you keep? Where can you invest your collateral? All of these things are being negotiated at the moment, and then will be set in law in one way or another. The legal entity conundrum is yet another one. As you can imagine, regulators are used to having someone to blame or someone to take the responsibility. When that is a decentralized community with a lot of governance tokens around them, that process becomes a little bit harder to figure out. I don't want to kind of create the impression that Brussels doesn't understand that. They do. But the important thing is that you have to make them care about adopting a way of doing things that is different than traditional finance. Other risks are around AML, KYC. We had the EU just published their what we call the anti-money laundering package this week. And for those that are focused on the space of exchanges or service providers, that means the travel rule. So anybody looking in the exchange space would recognize that word. It means the disclosure requirements when money is moving from, or tokens are moving from one service provider to another, you have a lot more disclosure rules there. Sustainability is an interesting one because it rose to the political horizon very fast. Not that it wasn't recognized by the community, not that it wasn't there for a long time, but it kind of became a hot topic in Brussels for over a month, I would say. And the level, what we do with it, to the extent that we understand that protocols are different and they have different sustainability footprint, the conversation that we're having that actually the solutions could be within the community itself, these are all in very nascent stage in Brussels. Very few institutions are talking about lending. There's far more lending activity on the business side than there are conversations about it on the regulatory side, but it's coming because regulators recognize, they know to be afraid of shadow banking, which is a concept that we had after the financial crisis. So crypto lending could be defined as shadow banking, and that already signals alarm bells in a regulator's mind. And the conversation about all of these risks, the underpinning kind of the dynamic is the recognition of whether or not there is a value to society of all these tokens. Now, if you come to a conference like this and you pose a question, the answer seems obvious that there is. It's less obvious in policy, in rooms where negotiations happen, and therefore having platforms that continuously advocate and represent and have case studies and so on about this fact is that much more important in Brussels. So the law that I keep on referencing is still being negotiated. It's called the Markets and Crypto Assets Regulation. In the EU, it's called MiCA, abbreviated as MIKA. It's been almost 12 months on the negotiations table. The Council doesn't agree with it. The Parliament hasn't figured out what they think about it. They had nearly 1,200 amendments on 168 pages, if that gets anyone excited. So it has been quite a lengthy negotiation process, and it's still not over, which means that there is room for influence. But as we always say in my line of work, the closer you get to the final line, the smaller the room for influence gets. The interesting thing here is that the EU has a bit of a head start advantage. The US is behind us in terms of thinking about this, other jurisdictions too. And this is what we call the Brussels effect, and we love talking about it because obviously we live in Brussels and we think everybody should do it as we do. But indeed, the EU has quite a track record of thinking up regulation, which then reverberates around the world, around data, around banking standards, banking capital, for example. And MiCA is a good candidate for something like that happening in other jurisdictions. But the longer we delay the agreement on MiCA, the more other jurisdictions might be, particularly the UK, could be catching up on their thinking. INATBA engages with MiCA through their finance working group, which, like I said, is one of 15. There's about over 100 people there. It does focus on MiCA, but also anti-money laundering, the impact on the DeFi community more broadly, and also things like smart contracts and tokenization. They also set up a MiCA task force beyond the limits of their own membership. So that was more of an open platform that allowed non-members to also contribute to the debate and be taken into consideration. As part of the work, as I said, there's a finance working group, there's an academic advisory board which kind of inputs their thinking into the final positions, and I'll tell you what positions are in a moment. And there is a small secretariat that is very, very busy putting that whole thing together. Now, policy positions are the things that you go and you talk to a policymaker about, and that's a very commonly understood process in Brussels. When you're running a trade body that has 168 members, 63, sorry, and then when you open a platform for outside of your membership input, then you go through quite a lengthy period of reconciling all these positions and coming up with the ones that matter to the biggest number of stakeholders. And those are the 5 that INATBA put forward to. Doesn't mean that there are no other issues out there with the crypto law, but those are the ones that matter the most to the members that this organization has. So it has to do with things about, it has to do with the definitions of crypto assets. We had this talk here, if anybody was in the room earlier, about the moon party and whether the ticket to the moon party is a security or something else. That question has its home in the first issue that INATBA has pinpointed. I already talked about some of the requirements that are difficult to comply with if you're a DeFi project. Credit institutions, as well as holders of other licenses, can comply, can provide crypto services or issue tokens without a separate license. And in the opinion of INATBA members, that shouldn't be the case. Lack of transitional arrangements means that the rules apply from the moment that they are agreed. And that, if you understand the urgency and the concern of the European policymakers that someone will come and start behaving like the European Central Bank, then you understand why they want the rules to be applicable from the moment that they are agreed. And then there were some limits on how much you can raise, basically, through a crypto project. And one of the things we're advocating for is that you take a note from existing legislation and you increase these limits. Again, history really helps when you understand Brussels. Very few issues are really new. Some of the debate, one of the tricks is to recognize how the debate that we're trying to have at the moment fits with the debate that is had in the past. And in this case, how much you raised with an initial offering is a really hot topic across member states, and that makes the issue more political. The other really important thing when you advocate in Brussels is that you don't only figure out problems, you also offer solutions. And that's been a big part of our strategy with INATBA. For example, for activities, on the definition issue, we propose that the definitions are more activity-based. So you get regulated based on what you happen to do with the token. If you're a token that you're trading on a crypto exchange for the purposes of creating an investment value in it, then it's one type of token. If it is a stable coin that is backed by a combination of commodities, cryptos, and other currencies, but you use it for payment, that's a different kind of token, for example. then the solutions on the DeFi space are particularly interesting because there is an open door for the DeFi community to particularly engage with the Commission and think through the really non-trivial question of how you apply regulation which is written for entities in a structure where entities do not exist. Because just because entities don't exist doesn't mean that governance doesn't exist, just exists in a different shape or form. So there is the promise that this kind of process can take place after MiCA is negotiated. So the things that we're really focused on in the moment is what will be agreed during MiCA. And how much of that future process will be influenced by discussions that we're having today. The credit institutions one is particularly tricky, to be very honest with you. I think the views of the industry are understandable, but to get credit institutions to get for another license, it's a very kind of political issue. This one there's more movement on the transitional arrangements one has more kind of more scope for maneuver, because one of the things that we're looking at the moment is where all the member states sit, where the various political groups in parliament sit, where the commission sits. So we're kind of reconciling all these views. Just give me a second. To kind of figure out what the final rules are. None of what we see in the proposal is finalized. And regulations can really change up until the last moment. And the last issue, as I mentioned, is to align what's in MiCA with what's, or the last solution rather, is to align what's in MiCA with solutions that are out there in pre-existing documents. Let me just get to the end and then we can do questions if you don't mind. Okay.
Follow the slides. What is ART? What does it show?
Oh, right, sorry. ART stands for Asset Reference Tokens. So I was saying earlier, stablecoins in the language of the European Union can be two types. You either are backed by a single currency, single fiat currency, in which case you're called an e-money token because in the eyes of the regulator, you behave like money and therefore you get regulated by like e-money. Or you're backed by a number of fiat currencies or a basket of other things, commodities, other crypto assets, in which case you're an asset reference tokens and the rules are different. Sorry, if there was any other acronyms that I skipped, I'm sorry, that's a little bit of a work bias that we all have. Engaging with governments and regulation, needless to say, is really important. It defends the rights of this industry to operate in the EU. It doesn't much matter where you would be incorporated, for example. It looks like as long as you provide services to Europeans, wherever in the world you may be, you might be captured by the new law, and that's really important, I feel, for the industry to recognize. And like I said, INATBA works across a number of other topics other than financial services, and in one way or another, sometimes they integrate, particularly when you look at the energy conversation, the identity conversation, they all kind of connect to issues on financial services. So that's the end of what I had to share. You can scan all these links or emails and get in touch with INATBA. You can also find me after my talk, and I can either connect you to them or tell you a little bit more about what we do at FTI in Brussels. All right.
If you're looking to issue a stablecoin to people inside the EU, what would you say the sort of path of least resistance from a regulatory perspective is? So do you go sort of for a basket? Do you do it euro-denominated? Do you do it backed by real assets or backed by sort of decentralized assets like a DAI? Which one would piss off the regulators least?
I'm not a lawyer. This is not legal advice.
From your experience.
Yeah. Let me maybe paraphrase your question. The thing that regulators are most worried about is finding, creating something that behaves like money that's not exactly money. So the payments, something that approximates the euro, but it's not the euro, and it's not controlled and issued by the European Central Bank, worries them more than something that represents a basket of other stuff. And therefore, you see that in the proportionality of the rules. The other thing, of course, that worries them is how big of a stablecoin you create. So the higher volume, the higher market cap, the more member states that you are in, the higher the regulatory rules becomes. One of the distinctions that there are in MiCA proposed is that what you do with significant stable coins and smaller stable coins is slightly different. The regulatory attention to them is slightly different.
Thanks.
Yeah, related to that, what would there be a difference between creating like a euro stablecoin, which was either A, backed by actual euros, or B, not backed by any actual fiat asset, but backed by some sort of a DeFi system?
Yeah, so I'm smiling because I've heard that question before, but the thing is, what you say you're equal to dictates the collateral that you should have. So you kind of have to think of a regulator here, because the main thing is, if I'm your customer and you tell me that my token is equal to a euro, I have to be able to get my euro back in exchange for my customer at any given time. So what you hold to back my claim is then enshrined in law. You have to demonstrate to me.
But if you can't necessarily redeem it for a euro, you can redeem it for another.
Then you
DeFi.
can't tell me that it's equal to a euro.
Even if it's indexed by the amount of Bitcoin you can receive is equal to €1 at any given time.
So these rules are still shifting exactly what collateral you can hold, but looking at how they are in other in pre-existing regulation as well, typically you have to hold a third of your reserve in the basket of which you tell me that my token is equal to. If your basket is a euro, then it's euro. If your basket is something else, then it's something else. And then the other 70% you can invest, or read it, they can be something else. But you start by, what is the promise that you're making to your user, your customer? And then the regulator says, well, how are you going to demonstrate to me that you're able to fulfill that promise at any given time? And that's just kind of like the basics of liquidity rules.
Last question.
So I'm curious about the scope of those regulations. You say it's in Europe. I'm curious about Switzerland. So how does it apply to Switzerland, and how is Switzerland like willing to collaborate and enforce those rules?
So my current understanding, and the rules are shifting and all that, is that so long as you're providing services, and when I say providing services, say I'm a European Union citizen and I come onto your exchange, or I'm a European Union citizen and you've offered me tokens, then you're in scope for this regulation. And you can be in Switzerland, or you can be on the Cayman Islands, doesn't really matter. I think there is a different thing about how the Swiss are adopting their laws and how consistent the frameworks may be in the future.
Implementing a regulation that says if you offer or provide a service to a European citizen implies that you know what citizenship they hold. Yeah. What if you never ask?
Well,
and don't know?
So if you sell something to someone, you have to know who that someone is. That's the starting point. So if you're the provider or the issuer, and I'm your customer, you have to know who I am.
Well, you don't necessarily have to know their legal name and residency.
You do. You do. So this is the part of the.
I'm sorry, if I go in the supermarket and I buy a milk, Carrefour doesn't know where I am.
Yeah, but you're buying milk, huh? You're not buying money. Like so there's a difference. There's a different level of how much I need to know about you. Depends on what I'm selling to you. So for example, if I'm renting your car, I need to know that you're over 21 and you can drive. If I'm buying you milk, I don't need to do that. If I am selling you an investment product, I need to know who you are. So this, yeah.
I'm sorry, not to...
No.
But, for example, in Brussels, you can go in a shop in the city center and you can buy a piece of gold, and you don't have to give your ID, and you buy gold, and it's totally legal.
Yeah. Yeah. But I mean, it's I'm not going to argue the consistency of the rules, but in this case, this goes into anti-money laundering territory. So in Brussels, like for example, one of the debates is if I buy a prepaid cash card, should you know who I am? Should you not know who I am? And because of the terrorist attacks that we had, this was the conversation then, because you can trace a lot of the payments that were done on prepaid cash cards that were sold to people without asking who they are. And then they got used for financing terrorist activities. And that's why we had the conversation of now checking who you're sending cash cards to. Cryptocurrencies is very similar, and we're just about entering the discussions on AML. Like I said, the proposals came on Tuesday this week, and already the narrative is exceptionally conscious, because everything that policymakers read is how many ransom attacks happened this week, how many, how easy it is to get access to, illicit goods using crypto. And I'm not saying this is the argument, because it's also far easier to track crypto than it is, for example, to track cash. But it's just a matter of which one of those two arguments are put forward more effectively. Okay, I think that's a wrap.